Hi, my name is Heath Garrett, and I'm here with Travis Wright. We're sophomores at the University of Georgia, and this is our submission for the Office Properties Income Trust Restructuring Case Competition.
Yeah, so just to kind of start us off with an executive summary, OPI on the NASDAQ Stock Exchange, headquartered up in Massachusetts. It's an office REIT with with 125 properties in the portfolio. Last quarter it had a net loss of $41.2 million. Normalized FFO was 9.4 at just over 80% occupancy. In terms of kind of liquidity, $78.2 million with a revolver fully drawn. So, kind of with the capital structure, about $2.5 billion in total debt, which is kind of an over leveraged capital structure, as can be seen by the net debt to EBITDA ratio at just above 10x. And then the weighted average interest rate is 8.4%. On the right side of the screen, you can kind of see the tenant breakdown and moving into the capital structure now. So
Yeah, so for the capital structure in general, it's got a liquidity of around 78.2 million cash. The revolver fully drawn. If we've got a negative free cash flow of 52.8 million. The covenant pressure, the EBITDA to interest is around a 1.3x, and secured debt to assets is at 54%. The market pricing, the bonds are trading less than 20% yields, and it's a very big restructuring risk. In summary, the liquidation exhaust plus high secured leverage is a really big restructuring trigger, and the company is in extreme distress. Covering the liabilities, the secured revolver to term loan is about 425 million as of January. Will be at 425 million in January 2027. The senior secured notes are around 427 million and 910 million in 2027 and 2029 respectively. And then the unsecured notes are sitting at 491 million, and that's from 2026 all the way to 2050. Total debt, we're sitting around $2.5 billion. 80% of that's secured. And the maturity is really concentrated in 2027 through 2029. Only a little bit is going through 2050. And the collateral overlap restricts a lot of the refinancing opportunities because they already refinanced in early 2023. And then the higher leverage and cross-lien structure really constrains the liquidity, and it just puts OPI in a really bad position for restructuring.
yeah, just kind of for our what we believe could be a turnaround strategy for office properties income trust. Definitely, in terms of objectives, stabilize operations, preserve liquidity, and then refinancing the debt is going to be at the utmost priority. Going back to the stabilization, high yield credits or high credit tenants, excuse me, are going to be of the utmost importance, and then sell assets with any high yield debt that cannot be refinanced. We'll be able to reposition select assets to kind of more of a mixed use to hedge against just 100% office use. Got to bring down the interest expenses just to keep free cash flow to the firm, to be able to reinvest and pay down any mandatory debt repayments and interest. And then flex leasing and subletting will be able to monetize some of that vacant space. As we said, it's about 80% leased right now, so need to get that up when at all possible. In terms of kind of capital actions, definitely going to need to sell some non-core assets to pay down the revolver. That's the first thing that needs to be paid down before any refinancing efforts can be made. And then with the refinancing, debt maturities in 2027 and 2029 need to be exchanged and need to be pushed out to later and different dates. And then any kind of mezzanine debt needs to be converted into equity, whenever possible. Target outcomes, EBITDA needs to get up 275 to 300 million by fiscal year 2027 is a kind of a goal that we've set. Net debt to EBITDA is sitting just above 10 now. Would love to get that down to about 7 or maybe below, just to kind of fix capital structure issues, and then build any kind of a foundation for a REIT consolidation or merger, just to be able to keep OPI relevant within the real estate investment trust world, and be able to continue to compete and return to shareholders. So moving on.
Yeah, so the valuation summary graph is um, not properly pulled up here. I don't know why it's not displaying it correctly. But essentially, the comparables were a little higher. The DCF was kind of middle, and the president transactions were a little lower, as just president transactions have been slower and kind of valued lower in recent years. And the range that we found where there's the overlap was around 2.305 billion all the way up to 2.307 billion. And it's not appearing on the graph right now, but it's a small overlap. And so we think that range is pretty accurate, and we think it's a good place to start our valuation.
Moving on from there, public comparables, price to FFO, that's what's going to stand out the most as OPI is so low. But that is because their market capitalization is just extremely low. It's down 99% over the last 5 years. So that's something that's going to come with time, with investors becoming, more certain in the equity positions within the company. But our EBITDA multiples are going to be a little better. EV to EBITDA, a little low on the lower side compared to some of its comparables, but that can kind of be because of the net debt to EBITDA being higher. We're looking at about 10 to 11 average multiple on the EV to EBITDA. And so yeah, now we'll pass it along to the president transactions.
Yeah, so with president transactions, there's a set of comparable office building portfolios that have sold in the last 3 years. So there is a lot of M&A activity going on in that space. The average transaction value to the EBITDA is around 10x currently, and the average transaction value to FFO is 11.1x. OPI in general is kind of stacking up pretty similarly, a little bit below most of those companies, but it's still able to trade pretty competitively with those other office space companies, even though it's in a lot of distress currently.
Yeah, one thing I'd like to point out is, as you can see, the 11 OPI office assets that were sold. I believe that was late 2022 that it was sold, and it kind of gives a view on be able to see what OPI could sell some of their assets for. Bundle up a number of assets in a similar region. Just below the average precedent transaction value, but just kind of gives a view of any kind of strip asset sale that were to be needed or liquidation scenario. So moving on.
So on to the DCF, we were able to use a conservative case, base case or the street case, and an optimistic case. Over here on the right, this was using the conservative case. And so as you can see, not a lot of growth. They've been actually shrinking in recent years, and that is the conservative estimate for the decreasing growth. And so with that, we calculated through all the different metrics, and ultimately our base case enterprise value was sitting around 2.25 billion. Optimistic case was 2.3, and then conservative was about 2.1. The company is in distress. Their implied share price is negative, which means they really have to do a lot to sell off their assets, cover off all their debt if they want to return any value to the shareholders. On top of that, the street case or the base case was really based off analyst predictions for the market. We used that along with the 2025, since we were partway through the quarter, we were able to use a mid-year convention to kind of value those out and make it so that we know we're partway through 2025 and we didn't want to overvalue on just a whole year, even though we're halfway through.
Awesome. We'll move on from that to our liquidation valuation. This is kind of just showing, the book value of our assets and liabilities, and then the kind of the recovery assumptions of, what we're going to recover our assets for, and, the recovery rate of what we're going to have to pay our liabilities. We use the base case for the total recovered assets and then the total liabilities settled. So that's going to end up being about 2.3 billion in assets over just about 2 billion in liabilities to get to our implied equity value of just below 300 million. Divide that by the fully diluted shares outstanding. We were able to get a implied value per share at $4.20. If Office Properties Income Trust were to liquidate all their assets to cover their liabilities today. So not too bad for the common shareholders, but yeah, moving on.
Waterfall.
Waterfall analysis.
Yeah, so with the waterfall, we use the valuation summary to get this implied equity value of 2.3 billion. And from there, we had to pay off revolver, term loan, senior notes, the different percentages and the different maturity dates. And ultimately, all the debt was not going to be able to be paid back. So nothing was going to be able to be returned to equity holders. And as we talked about earlier, we talked about selling off non-core assets, and we used about a 10% liquidation uplift for that to get us to around $230 million dollars. And what that did is helped us get back up into the positive so that when we paid off the senior unsecured debt, that there would be a little bit return to the shareholders, even though it's only around $2 based on this implied enterprise value.
Awesome. Great work, Heath. Yeah, so for our alternative recommendation, based on our valuations, it's very difficult to derive any kind of intrinsic value based on future cash flows for OPI, comparative market value of the assets. Will be able to cover its debts while returning common shareholders a value which is higher than the current share price, which is below $1 actually on the open market. So because of difficulties and costliness of refinancing so much debt, with having to, pay fees on the refinancing and paying fees to an investment bank to be able to refinance it, a strategic alternative, in our opinion, would be a complete liquidation of OPI, just to be able to, salvage some value out of what is left. An asset strip sale on the market may or may not be necessary. This is just a recommendation of a strategic alternative, but it would be the quickest way to return value to shareholders in the short term. And based on our assumptions and calculations, based on what assets could be recovered, we believe that there would be a leftover chunk of money for the common shareholders. So this is something that we believe is a pretty plausible thing to do. So.
Yeah, I'd say overall, based on the market constraints with the refinancing, they refinanced in 2023. There's maturity coming up in 2027 and 2029. The most likely future for this company, for OPI, is going to be that strip sale. If they can get it out with refinancing, they will, and that could return value to the shareholders in the distant future. But for immediate shareholder value creation, strip sale will probably be the most likely plan of action.
Awesome. Well, we appreciate the opportunity to be able to pitch today, and hope that you enjoyed our pitch. And so that's what we have to say about office properties and their restructuring. So
Absolutely. Thank you.
have a good one.
All right. Now, how it's still recording.